Welcome back to Talk Tickers. It is Wednesday, February 4th, 2026. You are here because you want to get under the hood of the market, and today we are looking at a company that just reported earnings and promptly got taken to the woodshed.
Oh, it was a bloodbath yesterday. A complete bloodbath.
That is putting it mildly. We're talking about AudioCodes, ticker symbol AUDC.
And the stock closed down, what, almost 14%?
Down about 13.7% to $7.35. And the confusing part for anyone just looking at the headlines is that they actually beat on revenue.
Right. And usually a revenue beat, you get a pat on the back.
Not a double-digit sell-off.
No. And that right there, that's why we're doing this deep dive. AudioCodes is kind of the poster child for this very specific problem. The strategy is working, but the P&L is lagging.
It's an identity crisis playing out in real time.
A massive one. They're trying to go from, a hardware plumbing company to a slick voice AI software company. And the market sees the cost of that change and is, frankly, panicking.
Even if the AI engines are starting to rev up.
Exactly. The transition is just painful to watch.
Okay, so before we get into the market psychology, let's ground everyone in the actual numbers from yesterday morning. This is for Q4 and the full year of 2025. What's the headline?
The headline is really stability, not growth. For the fourth quarter, revenue came in at $62.6 million.
Okay, which is up. What?
It's up 1.7% year over year.
1.7. I mean, if you adjust for inflation, that is basically flat.
It's essentially flat, yeah.
Meh.
It did beat consensus by a tiny bit, about $600,000.
Right.
But nobody's throwing a parade for that kind of growth.
Right.
The real story and the reason for the sell-off is on the bottom line. The non-GAAP EPS, so that's the adjusted number, was 16 cents.
And that was okay.
That met expectations, but, and this is the big but, if you look at the GAAP EPS, the real unadjusted number, is only 7 cents.
7 cents. And you have to compare that to last year.
A year ago, it was 22 cents.
Wow.
So you've got revenue just kind of sitting there flat while your profits have just fallen off a cliff.
This is that P&L lagging thing you were talking about. They're spending more to make the same amount of money.
Precisely. For the full year, it's the same story. Revenue is $245.6 million, up just 1.4%.
Wow.
So the old business, the legacy stuff, it stopped bleeding. It's stable now, but they're taking every single spare dollar of profit and just shoveling it into the furnace of this new AI division.
They did try to, soften the blow for investors. I saw they declared a dividend.
Yeah, 20 cents a share, payable in March, and they bought back about 6.1 million in stock.
Which, for a company this size, that's not nothing.
It's significant. They are returning cash. But yesterday, the market did not care about the dividend yield. It was laser focused on those shrinking margins. The narrative was just, you're spending too much and we don't see the payoff yet.
So let's talk about this pivot. Because on the earnings call, the CEO, he was very explicit. He broke the business down into two separate units.
He was practically begging the analysts to model them separately so they wouldn't, drag the whole valuation down.
Yeah. He wants them valued differently.
You have to value them differently. So you've got unit one, connectivity. This is the legacy business.
This is the hardware, the plumbing.
The plumbing, exactly.
Yeah.
Session border controllers, the media gateways. If you have a desk phone at your office, there's a good chance AudioCodes made the box in the server room that makes it work.
And this is still where most of the money comes from.
It's the mothership.
Yeah.
It's 93% of their revenue.
93. So this whole AI story we're talking about it's just a sliver.
A tiny sliver right now. But that connectivity business is the cash cow. It's profitable, had a 14% operating margin in 2025. It's mature, it prints money.
And that money funds the experiment.
It funds the experiments, exactly.
Okay, so that's the side of the business that, pays the mortgage. Then you have unit two, voice AI.
This is the startup they're building in the garage. It's only about 7% of revenue. They exited 2025 at maybe a $17 million run rate.
But the growth here is what's supposed to get people excited.
Completely different profile. For the full year, it grew 35%. But in Q4, it actually accelerated to over 50% growth.
50%. That's usually the magic number that makes tech investors salivate. So why didn't that save the stock?
Because of the burn rate. This part of the business is in what they call investment mode.
Which is code for losing money.
Code for losing a lot of money. It's got a budget burn of $9 to $10 million a year. And management was very clear on the call. They do not expect this segment to break even for another 3 years.
3 years. In this interest rate environment, asking investors to wait until 2029 for a profit it's a huge ask.
It's an eternity. The market is looking at that $10 million burn and saying, we see the expense right now today. We just have to trust you on the revenue tomorrow. And trust is in very short supply when your stock is down 13%.
Let's dig into where that revenue is actually coming from. AudioCodes has, for forever, been tied at the hip to Microsoft Teams.
Oh, yeah. Microsoft Teams is still the sun in the solar system.
If Teams wins, AudioCodes wins. Is that still true?
It's still the core of the story. They said PSTN users on Teams reached 26 million.
Okay, hold on. Let's define PSTN for anyone who's not a telecom nerd.
Right. Public switch telephone network. Basically it means regular phone lines.
So if I use Teams to video chat with my coworker, that's one thing.
That's just data.
But if I use Teams to actually dial a phone number, like call a client on their cell, that's PSTN.
That's PSTN. You need a license for that, and you need hardware and software to bridge that gap.
Okay, so 26 million people are now using Teams as their actual telephone.
Correct, and that number is up, 16, 17%.
Yeah.
But here's the gap. This is what AudioCodes is betting the entire farm on.
What's that?
There are 320 million active Teams users globally.
So 26 million out of 320 million, that's less than 10%.
Exactly. About 90% of the people using Teams are just using it for chat and internal video. They still have a separate phone on their desk, probably a Cisco phone.
And AudioCodes sees that as, what, 80 to 100 million potential new users?
That's their total addressable market right there. All those people who will eventually switch their desk phone over to Teams.
I have to play devil's advocate here for a second. What if they don't switch? Maybe they're happy with their desk phone and their cell phone. Is that market really there?
That is the risk.
Yeah.
But AudioCodes is showing they can win them over. They pointed to a big 36-month deal with AT&T for a large university migrating off of Cisco.
Migrating away from Cisco. We hear that a lot lately.
It's a huge trend. The old on-prem phone systems are finally dying. And AudioCodes wants to be the bridge that walks these big organizations from the old world into the Microsoft cloud world.
But they're not just selling the bridge anymore. They want to sell the software at the destination. Let's talk about a product called Voca CIC.
Voca CIC. That stands for Customer Interaction Center. Think of it like a contact center light that lives right inside Microsoft Teams.
So instead of buying some huge, expensive, standalone call center software,
you just plug this into Teams. It uses AI for call routing, for voice recognition, all the basic stuff. And that product's revenue grew over 55% for the year.
What's the selling point?
Speed. They talked about a deal with a top 5 global BPO, one of those big outsourcers, who deployed it for a healthcare client in weeks, not months.
Weeks. In enterprise software, that is lightning fast.
It's their wedge. And they're also trying to break out of that Microsoft-only bubble. Their Meeting Insights tool, which, records and summarizes meetings with AI, it now supports Google Meet. And Cisco WebEx support is coming this quarter.
So they're becoming platform agnostic. That's a pretty important strategic shift.
They have to be. They have to be everywhere voice happens.
Oh.
And for me, this was maybe the most fascinating part of the entire call.
Yeah.
They highlighted a macro trend that goes against everything we've been told for the last decade.
You're talking about cloud repatriation.
Yes, repatriation, bringing data back home.
For 10 years, the story has been kill your server room, move everything to Azure or AWS. You're saying that's reversing.
Well, according to AudioCodes management, the percentage of businesses who plan to keep users on-premise, it jumped from 5% to 15% in just the last 2 years.
A tripling of the stay local crowd. Why? Is it cost?
It's fear, it's data sovereignty, it's security, it's regulation. If you're a defense contractor or a big bank or a government, you are getting very nervous about sending your sensitive voice data into a public cloud AI model.
Because you don't know where it's going or who is training their models on it.
Exactly. The cloud is leaky from their perspective.
Yeah.
And AudioCodes is capitalizing on that fear. They launched Meeting Insights on-prem, MIA on-prem.
So it's the same AI tool, but the server sits in your building.
Your building, under your control. And they have proof it's working. They mentioned the Israeli Nimbus contract, securing government ministries specifically because they can guarantee the data stays local.
That's a huge differentiator. Everyone else is racing to the cloud, and AudioCodes is building fortresses in the basement.
And in a world with more regulation and geopolitical risk, that basement fortress could become a premium product.
Okay, let's pivot to the forward-looking guidance because this all ties back to why the stock dropped. What are they telling us to expect in 2026?
The guidance was Well, it's tepid. For revenue, they're guiding between $247 million and $255 million.
So again, very modest growth, maybe 3 or 4% on the high end.
Very modest. EPS non-GAAP between 60 and 75 cents. But the number they really want you to watch is ARR, annual recurring revenue.
The subscription money?
The subscription money. They exited 2025 at $79 million, which was up 22%. They're targeting $92 to $98 million by the end of this year.
So they're trying to get investors to look past the flat top line and focus on the recurring engine they're building underneath.
That's the hope. But there are serious headwinds. We have to talk about the tariffs.
Right.
Management flagged a $2.3 million impact from tariffs in 2026.
$2.3 million. For a company with their margins, that is not a rounding error.
No, it's a direct hit. It goes straight to the bottom line. It wipes out a huge chunk of any efficiency gains. And then there's the people shift.
The R&D costs.
This is massive. They have about 1,000 employees, 350 of them are in R&D, and they've moved 150 of those people to work only on voice AI.
So nearly half their entire R&D department is working on the new stuff that's losing money?
Correct. And that's expensive. The market sees investment mode and just hears lower earnings for longer. The stock drop is the market saying, show me that 50% AI growth can actually move the needle on profit, because right now it isn't.
It's the classic innovator's dilemma. Do you keep milking the cash cow, or do you starve it a little to feed the new calf? They're choosing the calf.
And the market is grumpy about the diet. And, you can't blame them until the numbers actually turn.
All right, let's shift gears. It's time for our This Is Not Financial Advice segment.
My favorite and always the most dangerous part of the show.
This is where we take the data and spin up a trade idea that is, let's say, wild but plausible. Please do not do this with your retirement money. What's the pitch?
I'm calling this one the sovereign AI straddle, or if you want something simpler, the on-prem contrarian play.
The sovereign AI straddle. Okay, break that down. What's the thesis?
The thesis is that the entire market assumes everything is going to the public cloud. The valuation of Microsoft, Amazon, NVIDIA, all of it is built on that assumption.
Right.
But the AudioCodes call just highlighted this repatriation trend. Governments, defense, finance, they're getting scared of the public cloud.
Okay, so the contrarian view is that the cloud isn't the final destination for everyone's data.
Exactly. So here's the trade. You go long AudioCodes specifically as a hedge against cloud AI regulation risk.
A hedge against regulation. How does that work?
Think about it. What if 2026 is the year we get major AI data privacy regulation? The EU, or the US government, says you can no longer put sensitive citizen data into a public large language model.
What happens then?
Well, the pure cloud AI stocks take a massive hit. Their addressable market shrinks overnight. But AudioCode,
They've got the on-premise solution ready to go.
they've got MIA on-prem, certified for government use. They become the only safe harbor for enterprise voice data that legally cannot leave the building. You're buying the boring hardware guys because they own the keys to the physical fortress.
So while everyone else is panicking about AI compliance, AudioCodes is just sitting there saying, we never left the basement.
Exactly. And the kicker is the dividend. You get paid to wait. It's boredom arbitrage.
Boredom arbitrage. I like that. You're basically betting on the bureaucrats to ruin the cloud party.
It's wild, but when you see that number jump from 5% to 15%, the trend is already starting.
It is definitely plausible. Okay, let's wrap this up. We've covered a lot of ground. What's the final recap?
The recap is simple. AudioCodes is a company in transition. They beat revenue by a hair at $62.6 million, but got hammered down 13% because profits are shrinking to pay for a massive AI pivot.
The connectivity business is the stable boat, and the voice AI business is the new sail they're trying to build while they're already at sea, and that sail is very expensive.
It is. The key metric to watch in Q1 2026, and really all year, is that voice AI growth rate. Does it stay above 50%? If it drops, the whole story breaks. If it accelerates, maybe the market starts to forgive the cost.
And that brings us to the end of this deep dive. We always like to leave you with a question to think about. We talked about cloud repatriation. My question to you is, do you believe it? Is this a real micro trend, or is that just a comforting bedtime story that hardware companies are telling themselves to stay relevant?
It's the question that decides if this stock is a value trap or a hidden gem.
Let us know what you think. And as always, do your own research. Thanks for listening to Talk Tickers. We'll catch you at the next bell.